Hello everyone, welcome back. First video update for 2022, and I thought it was timely given that there is a lot going on around the world and a lot of it is having an impact on markets and thus portfolios that I know is on the minds of quite a number of you. So I thought it was timely to provide a brief update. I won't go into the humanitarian aspect of what is going around the world and domestically at home, other than to say that obviously it is terrible and we feel for those who are affected, and thinking of our clients who are in that impact zone, particularly with the floods up in Queensland. So in terms of the war with the Ukraine, Russia itself isn't as big an economy as you might expect from a population of 145 million people. It's about the size of Canada and is a little bit larger than the Australian economy. The one thing it does have is natural resources, and represents about 40% of Europe's gas supply. And so from the impacts rather that this will have is that gas prices and energy prices are likely to rise off the back of it, and Australia as a net exporter of energy is likely to be a beneficiary of it. So in a sad way, this could actually or should provide a short-term bump for Australia from that, and will be a net beneficiary of that, as the collapse of the ruble makes exports a lot more expensive for Russia, and secondly that countries will look to other sources rather than Russia to supply that cost. So better news for Australia, I suppose, on that front. What it does do though is continue to impede supply chains, and will continue to have an effect on the short-term inflationary pressures that we're seeing around the world as a result of COVID as we come out of this last few years. And what that does is continue the uncertainty that we've seen, and we know in periods of uncertainty, volatility increases with markets. So that's a result of what we've seen over the last few weeks. More so than that, and the bigger issue at hand is that of inflation and rising interest rates, which is something that you'll recall we've spoken quite extensively about, particularly over the last 12 months, indicating that these periods of historically low interest rates won't be able to go on forever, and at some point will rise, and we've reached that point now a little sooner than expected. We've been keeping portfolios and the fixed income parts of the portfolios short duration in anticipation of this. However, in October last year, markets rose very quickly in the fixed income space as a result of them effectively acknowledging what I've just said, and indicating that they no longer believe the central banks around the world were going to be able to keep rates as low as they have for as long as they have. And the spillover of these inflationary pressures will force central banks around the world to start to raise rates sooner than anticipated, and by a lot more than they were thinking. This was confirmed in November. The RBA acknowledged that that was what they were going to do, to abandon this monetary policy. And again, that saw rates increase quite extensively, to the extent that October was the second worst performing month domestically for bonds and fixed income, second to February 20 when COVID broke. In the US, we saw then in December inflationary numbers of around 7% for the month, which reinforced again markets' view that the Fed was behind the curve in this regard, and they were going to have to raise rates much sooner than expected, as the economy, particularly in the US, was running red hot. What that did is trigger essentially a re-rating across the board, and was most pronounced, I suppose, in equities that we see through the portfolios. And saw this re-rating saw a sell-off, particularly for sectors around technology that rely on and have been net beneficiary through the tailwinds of these low interest rates, as they rely heavily on borrowing and having their discounted cash flows extended for long periods of time. So where to from here, I suppose, is that domestically it would appear that markets are pricing in a 100 basis point increase, or 1% in the official interest rates. And in the US, we'd seen recently the inflation curve turn negative. What this means is that once these interest rates start to take effect, that these inflationary pressures that markets are nervous about or worried about should start to taper off, and things should start to moderate, which would mean or indicate that interest rates will slow down, the rate of increases will slow down, and we will start to see a bit more stability through the system. So in the short term, probably a little bit more volatility to come through before we sort of settle in for a bit more of a new normal. So that's it for us today. A little bit short and sharp and sweet, but for those that are concerned about your individual circumstances or have any questions or want to discuss this further, feel free to get in touch with us. Otherwise, bye for now.